Magnite was a company that I previously invested in but have since sold my position. I made about a 300% return, but definitely left money on the table. At the time, I thought the company was overvalued by a lot. I was even very generous in my DCF model. I gave the company 40% revenue growth for the next 5 years, and the company's past performance definitely do not justify that. Before I do any valuation, I always like to look at the company's financial statements. This is their cash flow statement. I just reorganized some of the line items to make it flow better. Their net loss doubled since last year. That's not surprising considering the pandemic. Fortunately, non-cash expenses contribute a large part to that loss. One thing that is concerning is that half the company's 2020 revenue is sitting in accounts receivable. If we calculate the average number of days it takes for the company to collect on the AR, it's a little more than a year and a half. That's very concerning. It doesn't matter how much a company make in revenue if they can't collect on it. That's just a non-stop ticket to bankruptcy. They spent some money on PP&E and developing an internal use software. That leaves them with a negative free cash flow of 34 million. So the idea of a growth company is that it reinvests its earnings back in the company. So we should expect the company to have double-digit revenue growth. At first, it looks like that is the case with this company. If we look at the income statement, it looks like they have a 42% year-over-year revenue growth, but the 2019 figure does not account for Talaria's revenue since the merger happened after Q1 of 2020. So in actuality, the company had a 5% revenue growth. One argument people could say is that the pandemic hurt a lot of companies, and so they cut the advertising budget. But if we look at Trade Desk, they had a 26% year-over-year revenue growth, and they started at a higher base. This makes me question management's operating decisions. But let's see how they are funding their endeavors. They got 50 million in cash from the Talaria merger and 13.5 million from stock options. So basically shareholders' equity got diluted. Let's look at some more ratios. Return on equity is not great. Return on assets is also not great. The gross margin looks good since it's a tech company, but SG&A cuts through all of it. The current ratio and quick ratio looks good, but this includes accounts receivable, so I'm a bit wary about these numbers. They also have a 40 million credit facility that they could borrow from any time, so I'm not too worried about bankruptcy. They also don't have any real debt besides for operating leases. So overall, 2020 does not look great for Magnite, but they recently acquired StockX, so that's something to look forward to. Their revenue basically doubled, and there will be cost synergy. So Q1 of 2021 is going to be interesting.